What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training and another episode of IUL Fantasyland. That is what I'm calling it now. It used to be called Fun with IUL Comments until I came up with a better name. Right now, it is IUL Fantasyland because the more I engage with IUL agents or just advocates of IUL in general, and we have a back and forth debate, etc., it's more and more clear to me that these people just live in Fantasyland. It's incredible. And for those of you that are advocates of IUL, and you're likely going to hate this video, I'm going to put something up on the screen right now just to have a little bit of fun with you because, hey, at the end of the day, if you're not having fun with this, what's the point, right? So, and I'm having a lot of fun here. But to get serious, I want this video to bring clarity around IUL. I want it, my goal is to expose the risks involved. And at the end of the day, if you're okay with the risk, once you understand how these products actually work, how an IUL works, if you still want to roll the dice, be my guest. I do not care. You're an adult. Do whatever you want with your money. The problem is most people have no idea how an IUL works. They have no idea what they're putting their money into. And I know this because I almost bought an IUL based off of all the hype, all the amazing benefits that you're going to get from an IUL. It wasn't until, thankfully, before I purchased an IUL, I learned how these things work, all the things that can go wrong. At that point, I was like, I want nothing to do with this, and I thank my lucky stars every single day that I did not purchase an IUL. Now, if you want to, when you understand it, fine. I don't care. I personally think it's pointless. It's a pointless product, and I've done videos on this, but you can get upside potential, downside protection in the market in a whole life product and not have any of the issues of IUL, just so you know. So what's the point of IUL? I don't know. You tell me. Drop some comments down below. But I want you guys to know how this works. Like if you're considering an IUL, I just want you to know how it works so you know what you're getting involved with and what you're putting your money into, because so many people are getting hurt by these these different types of universal life insurance products. I don't care what kind it is. It's still built on universal life. It's still built on annual renewable term, and it can cause a lot of problems, especially when you start taking income from it. Like IULs don't really have a problem in the accumulation phase where the cash value is growing, et cetera. It's when you get older, when you start taking income from the policy. Like that's where you can run into a lot of problems, and you have to be very careful. I just don't want you guys to get hurt. All right, so let's dive into it. Let me share my screen. I want to go through some interesting just kind of funny comments that I've had on some of my content recently. And then I want to take you to LinkedIn, go through some of the back and forth that I've had with some of these IUL agents. And I think it's going to bring a lot of clarity to the different aspects of IUL and what can go wrong with them. That way, you know what questions to ask when you're talking to IUL agents, et cetera. You know what to look for, and you can make the best decision for you on whether or not this is a good idea. 99 times out of 100, I think most people would say this is a terrible idea. It's a terrible product. I don't want anything to do with it. But anyways, my goal here is just to bring some clarity to it. So let's start with a little bit of entertainment here, and then we'll get to the really juicy stuff. The first thing I want to do is go through a couple of comments that were left on my video here. Risk of universal life insurance. And this video, I actually break down, unfortunately, a real life story of a 94-year-old woman whose policy lapsed. She lost all of her premium payments. She lost the death benefit that she wanted to leave to her two daughters. It was really, really sad. She thought her premiums were going to be stable the entire time. And this scumbag advisor sold her a universal life insurance policy at 79 years old for the stable premiums. Like, just absolutely egregious, criminal, in my opinion, just a complete violation of his fiduciary responsibility to do right by his client. Absolutely disgusting. There's a lawsuit now. Like, it's really sad. And in the video, I link to the article if you want to check it out. And I just break down the risks of universal life insurance, why this happened to her, so that you know how it works. And the first thing that this person says, basically he just blames this lady for what happened. Like, sounds like the lady didn't fund her policy properly all those years. Okay, so it's the client's fault. That's what we're doing now. We are blaming clients for the failure of this terrible, terrible, very risky product. Really, that's a new low, in my opinion. So there shouldn't be any accountability whatsoever for the advisor that sold this to her. Did he structure it properly? Did he tell her that she needed to fund it in a certain way? Or did he tell her that there were going to be stable premiums? That's why they set it up. Like, absolutely ridiculous. UL should always be funded as if only the guaranteed rate is going to be paid. Wrong. Like, if you look at the guaranteed column of a universal life policy, you would never buy it because it just oftentimes it just shows your policy lapsing. That's just absolutely ridiculous. Now, he might be talking about a guaranteed universal life policy, which is a little bit different, but that's not what we're talking about here. Most of the time, the policies that are set up, UL, VUL, IUL, that's usually what we're talking about here. So guaranteed universal life is a different conversation, but that's not what was sold to her. That's not what she bought. He's not making that distinction either. So I'm going to assume he's talking about just any type of standard UL, VUL, IUL in this case. Should always be funded. Like the argument of properly funding an IUL is just pretty ridiculous. Here's the thing. Does it reduce the risk of issues with the policy? Absolutely. I will not deny that. It doesn't eliminate all the risks, though. The cost of insurance still goes up every single year. You have to manage net amount at risk. If the net amount at risk gets too high, you're going to have a much higher cost of insurance that year, like what actually needs to be paid. And to manage the net amount at risk, you often have to lower the death benefit, which could potentially mech the policy. Not to mention, if you have to do that, that means your policy is failing and underperforming anyways. Why on earth do we want to deal with this, guys? Why are we rolling the dice with our financial futures on crap like this? It doesn't make any sense. I don't care how it's structured. There's still so many flaws, so many things that can go wrong with the product. Why are we rolling the dice with it? It's just absolutely ridiculous. And then, so I brought that up here. And then his next question was, oh my, are you a financial advisor? Just completely useless comment here. Very unproductive. Not sure what that has. Like, I don't need to be a financial advisor to know bullshit when I hear it and see it and to call it out. Like, it just takes a little bit of common sense and just a basic understanding of how these products work to know that they are fundamentally flawed. They are very risky. And oftentimes we want to stay away with it, stay away from it. And heck, if this is what financial advisors are selling to people, I'm proud not to be a financial advisor. I am a licensed agent. I help people set up dividend-paying whole life insurance policies to implement the infinite banking concept because it is freaking amazing. I've done a ton of videos on that. But anyways, like, what am I saying about the product in the video that you disagree with? Okay, bring that up. That's a productive conversation. Not, are you a financial advisor? That's so irrelevant. It doesn't serve any purpose whatsoever. So anyways, that was entertaining. Let's go to this one here. This was a video, a podcast that I did with a friend and mentor of mine talking about WFG, World Financial Group, how it's a pretty sketchy company. Be very careful with it. The biggest issue that I have with it, though, is not that it's a crappy MLM company, but it sells index universal life insurance. And not only does it sell a terrible product, it sells it in a very terrible way. So that's kind of what we talked about in this video. And we covered a lot of the issues that can go wrong, a lot of the issues with IUL. And so this person basically said that we have no idea what we're talking about, which is useless. It's your fault that you joined an MLM like WFG and PHP. Okay, again, so it's blaming everybody else. No accountability for the company at all and their marketing practices, saying that you're going to live this amazing, lavish lifestyle by selling terrible financial products to people and you're going to recruit all these people. Okay, fine, whatever. There needs to be accountability on both sides. But then he says, please talk about an IUL like you do, which we did in the video. We talked a lot about the risks involved and all the things that go wrong. We can tell you have very limited knowledge. Really? About what? And I asked him, elaborate. What did we say that's inaccurate? Granted, this was only a day ago, so they might respond. If they do, in the next episode of IUL Fantasyland, I will bring that up. But no response yet. But like, it's just a useless comment because it doesn't create any discourse here, like some useful discourse debate that people can read and learn from. What is it that you disagree with? Don't just say I have limited knowledge. What did I say that was wrong? Because I'm pretty sure I didn't say anything wrong about IUL. This is how these things work. This is how these things can go wrong. Like, what do you disagree with? But then, like, this is how I know I'm dealing with clowns. Like, we wonder how old you are. Like, when they resort to personal attacks, that's how I know I'm dealing with a little child. in the industry, and just they're not going to back up any of their claims. They're not going to provide any actual facts to back up their claims. They're not going to address anything specific that I said about the product. They're just going to say, how old are you? 25, which I'm 35. So thank you for the compliment. I look younger than I am. I appreciate that. But age has absolutely nothing to do with it. Not really sure what the point of that is, but like, just, I wanted to show this to you guys though, to let you know like who you're dealing with sometimes in this industry. Now, and it can be in any part of the industry. I've seen childish comments and stuff on both sides of the argument here, but be careful with who you're actually working with. Are they resorting to personal attacks like this? Or are they actually engaging in conversation, debate, like, and are they an actual expert in their field, right? Just something to keep in mind. Okay. So next, this is the really juicy stuff that I wanted to get into, guys. Like, okay, this is some of the most egregious stuff that, and most ridiculous stuff that I have heard from IUL agents in a while. The first one is a post here on LinkedIn from this gentleman. And it was a pretty useless post. It provides like absolutely no context. It just says, hey, put this much in, and then you'll be a millionaire by this age. It's just ridiculous. So misleading. Tammy saved for 15 years. She put $850 into her IUL. $750 went to the magic bucket. That sounds really good, doesn't it? By the end of 15 years, she had $180,000 for child's college expense, blah, blah, blah. All right. At 62, Tammy was a millionaire. Okay. She'll never have to make any payments against the loan unless the policy is terminated. Got to be careful with that. I assume he's saying like if Tammy terminated the policy, but why would she terminate it if she's just going to continue making millions and millions of dollars in her IUL policy? Like, why would she ever terminate it? Doesn't make sense, right? So very, very limited amount of information selling this crappy product. Okay. What I really had an issue with was the comments, the back and forth that was happening with a gentleman that just asked a couple of questions here, calling it out a little bit. And there's a few parts of the comment that I want to bring up right here. Will a well-balanced portfolio always go up in value? Basically, what he's suggesting is that an IUL will always go up in value. Like your cash value is going to always grow. From a compliance standpoint, from a legal standpoint, I don't know how people get away with this. Like, this is the kind of stuff right here that gets people sued, that gets companies sued. When you make absolute statements like this, you're never going to lose money. Your money's always going to grow. It's always going to go up in value. You are begging for a lawsuit because that is never, ever, ever going to happen in an index universal life policy. And I'm going to show you some more details on that in a second because he had an argument for it on why it always goes up in value, and I'm going to show you why it's absolute bullcrap. All right. The other part that I wanted to bring up here, let's see, where's it at? As a matter of fact, so basically what he's talking about is like the market goes down every 3 to 5 years, which is going to negatively impact the performance of the IUL, and it's going to completely destroy the illustration that shows you an IUL growing every single year. Oh my God, it's just absolutely ridiculous. So by this very statement right here, he's destroying his own IUL illustrations. But anyways, it's true that when markets go down, they have to work harder to get back up. I do agree with that. For instance, portfolio drops 50%. It will have to go up 100% to regain losses. That is absolutely correct. Massive negative markets happen on average every 10 to 15 years. Okay, fine. In the program, I referenced Tammy's money always goes up in value. He's now said it twice that she will never lose money and her money will always grow in a product that is based on the performance of the stock market and cost of call options, etc. Guys, if we just use a little bit of common sense here, do you really believe that? Like, no, that's just ridiculous. Okay, let's see what else. He's talking about 529 plan. I don't care about that. Also, when you use money, money's gone. Yep. Okay. So I think that was it on this particular comment. So then the conversation continued. He's talking about annual versus actual rate of return, which I do agree with. I've done a whole video on that. Okay. I'm not going to argue that. Here's the other part of the other comment, though, that I really, really had an issue with. Can you guarantee that it will never go down in value in any given year? This is the basic crux of the question. The answer, of course, is no. He's talking about the balanced portfolio of stocks and bonds, Roth IRAs, that kind of stuff. But he's saying that this is something an IUL strategy can do. It can never go down in value in any given year. That's what he's saying. And then he says that, like, I can't stand when that, like, this is just hilarious when IUL agents use the fact that titans of industry have used life insurance as a very good wealth building strategy, which they have. But you know what they didn't use? IUL, because IUL has existed only since 1997, I think. And when I comment on the video, on this post, I'll show you his response to this, because I bring this up. JD Rockefeller did not use IUL. He absolutely probably used whole life insurance. He probably used this strategy that he's talking about, but it has nothing to do with IUL. If JD Rockefeller were alive today, he would laugh IUL agents out of the room. Like, he would actually probably be the one selling IUL because it's so profitable, but then he'd take all of his profits from selling IUL and then go buy a whole life insurance policy, like he actually did. So using JD Rockefeller and, J.C. Penney and Disney, Ray Kroc, all that, like, just come on, guys. All right, so that was pretty funny. But then let's see. Okay, so this is where I left the comment, and I just asked him, like, please explain how her money will always go up in a product based on stock market performance. Number two, I wanted him to actually say that he guarantees to Tammy and others that her cash value will never go down. They will never lose money. And then I just called out the Rockefeller BS. Like, dude, he didn't use an IUL. None of the super wealthy families do. It's just ridiculous because it's such a crappy product. There's just too many things that go wrong. But then he actually explains this. Like, he responds, which I appreciate. Okay, I will give him credit for that. The returns Tammy gets are tied to an index. Okay, let's use the S&P 500 for example. When the S&P 500 goes up, Tammy's cash value will go up as well by that amount, with a cap of about 15%. That is not true. The 15% cap is a gross rate. That's actually really high. It's probably, I don't know, maybe there's some companies that do a 15% cap, but it's not going to grow by 15%. Ask your agent, let's say I get a 15% interest credit on my IUL. What did my cash value actually grow by after expense, like cost of insurance, fees? Again, in the beginning, this is not IULs are not really a problem. When you start taking income, you start taking policy loans to create that tax-free retirement income, and you have a down year, but you have a balance of $500,000. And I actually asked him this, and he did not answer it. I asked him, when you start taking income, you've racked up a $500,000 loan balance at 5% interest, and now you owe $25,000 in interest that year, but the market didn't go up. Where does that money come from? You have $25,000 of interest that is due on that policy loan that you've been using to create tax-free retirement income. Where does that come from? It comes from the cash value, which means you will absolutely lose money in an IUL. And he did not really address that. So the 15% cap, whatever, like, your money's not going to go up by that, number one. There's costs associated with the policy. There's costs associated with the indexing strategy itself, the cost of buying call options, particularly after the surrender period as well. I just watched a whole training on how that works. It's just mind-boggling. All right. After the surrender period, the budget to purchase the call options to create this indexing strategy just plummets. Okay. Which creates a real problem in the policy. The IUL is given a token growth even when the S&P goes down, he says roughly about 1%. What does that even mean? Is it 1%? Is it 0.5%? Is it no percent? So Tammy is guaranteed growth in this window. I would actually like to see the contract on that, showing an IUL policy guaranteeing growth every single year. Maybe they can actually do that. Like, they can guarantee 1%, but that doesn't mean it's going to cover all the costs of the policy. That doesn't mean it's actually going to grow every single year. They might try to credit you 1%. He says roughly 1%. What does that even mean? But is that enough to cover the cost of the policy when you are 70, 75, 80 years old, you have a $500,000 loan balance, a $200,000 loan balance, I don't care what it is, and the market goes down, is that 1% going to cover all of the fees and costs associated with that policy that year? Nope. Never going to happen. All right. Yes, you can guarantee that the cash value will never go down. Dude, you're getting sued at some point. Like if you were to forward this to this guy's compliance department for whatever company he's contracted with, I would be amazed if he did not immediately get not fired, but have his contract terminated with them. Like, this is such a violation of God knows how many compliance regulations. Guarantees that the cash value will never go down. I'm screenshotting this too, I'm doing the video too, but just in case he ever decides to delete it. There are no instances where costs are ever taken from someone's cash value due to a down year. I cannot, guys, I got to go full screen for this. Oh my God. Whoo. I cannot believe that there is an agent out there putting this on a public forum saying these kinds of things where the costs will never be taken from somebody's cash value due to a down year. That is a straight up lie. If anybody ever tells you stuff like this, run the opposite direction. In fact, I would call up the company that they are contracted with and say, hey, this agent is telling me that cost for the policy will never, ever be taken from my cash value. Is that true? Call up the life insurance company and ask them that and see what they say. They're going to, I almost guarantee you, they will ask you, no, who told you that? We want to know who told you that right away, because that's the kind of stuff that gets them sued. As far as loans, 5% is a horrible rate. No, that's pretty average right now for most companies, 4 to 6%, right in that range. Typically, rates are 1 to 3%, and they will never have to pay the loans back. That's kind of a half truth. If the policy, oh shoot, I'm sorry, I forgot to share my screen again. Going through right here. He says, as far as loans are concerned, 5% is a horrible rate. That's not true. 4 to 6% is the kind of the average. He's saying 1 to 3%. That's not true, or I highly doubt it, unless he's talking about a wash loan. But IUL agents don't illustrate wash loans. So you have indexing loans, which are participating loans. It's what makes the IUL look really good in the later years, because it shows the growth of the cash value every single year, like it's some kind of eternal bull market. And then it shows 50 percentage points or 50 basis points of positive arbitrage. Okay, that's the indexing, like participating loan, versus a wash loan, which is it doesn't, like, that loan won't compound against you, right? Like an indexing loan will, and it wouldn't create that issue I brought up earlier about the loan balance, all the interest that's due. Where does that come from? If you do a wash loan, it eliminates that problem, but it creates another problem in the process, because now that money that you're borrowing is no longer earning the indexing credits of that policy for that year. So if you get that 15% cap, the money that you borrowed would not participate in that 15%. So now that completely destroys the illustration, particularly in the later years when you're taking income. It doesn't look anywhere near as good, but they won't show you that, because if they did, you would never buy it. It's ridiculous. So they'll sell you the policy showing you all this income with this participating indexing loan, because it looks really good on paper, but then they'll tell you, oh, but you can mitigate that interest, cost, risk, whatever, by taking wash loans. But they won't show you what that actually looks like, because then you wouldn't buy it. It's absolutely ridiculous. So that might be what he's talking about. It's not a solution to the problem whatsoever. You'll never have to pay the loans back assuming that your IUL lasts that long, which it most likely won't. It will most likely blow up in your face. Then technically you don't have to pay loans back, because it's collateralized by the death benefit. So when you pass away, the death benefit will cover whatever loan balance you have, and then whatever's left will go income tax free to your beneficiary. So that is true, but again, is your policy going to make it that long? Probably not. You are correct. Rockefeller did not use an IUL because it was not around then. That's true. However, the concept has been around for 125 years. That's true. More Rockefeller family using IUL. Really? You have proof of that? I doubt it. He's just pulling stuff out of his rear end here to try and make his IUL sound really good. I seriously doubt if you had a conversation with a Rockefeller family member and you asked them, hey, do you guys own IUL? They're going to say, absolutely not. They're going to own a ton of dividend paying whole life insurance, but the Rockefeller family members are really smart. Their family offices are really smart. They got really smart people working for them. Seriously doubt they would roll the dice with any of their fortune on a crap product like IUL. He says it's a far superior product compared to whole life. That's absolutely ridiculous. I've done a ton of training on this. When you understand how these things actually work, you will likely agree with me. IUL is superior on paper. It looks really good on paper, looks far better than whole life on paper. But what happens in reality, not Fantasyland? When our vacation to Fantasyland is over and we come back to reality, which one actually does better? It's whole life. IUL typically blows up in your face. Now, one other comment I want to bring up. It's an agent that I have a lot of fun with. We go back and forth pretty frequently on different aspects of IUL. So a friend of mine here, Ian Vogel, which I recommend that you follow. He has a great channel as well. He owns IULrehab.com. He's got some great content and a really interesting experience and story with IUL. I've actually had him on my channel. I'll link that down below. It's really good stuff. But he did a post here on LinkedIn, and this gentleman chimed in, and him and I just started going back and forth on, just talking about IUL. But there was something that there was a particular part of the conversation I wanted to bring up that is so dumb. And these arguments don't make any sense, guys. I think this is also, okay, right here. Unlike whole life, IUL also has the option for zero cost wash loans. So again, the wash loan is the go-to argument for IUL agents whenever I bring up the issue of when you start taking income in the form of policy loans and an IUL, it injects an incredible amount of risk. And I actually asked him the same question, which they never answer. It's always like, oh, you could just do a wash loan. Okay. When you've racked up a $500,000 loan balance, the interest rate is 5%. You have a 0 year in an IUL. Where does the $25,000 of interest due come from? It comes from your cash value, guys. So you can absolutely get decimated in an IUL. You will lose money in an IUL on any given year, especially when you're taking income. He did not answer it. His go-to is always zero cost wash loans, which if you looked at an illustration of an IUL with wash loans, it would look terrible. Therefore, you wouldn't buy it. He tried to be a little clever here. When I brought that up, he said it can, when you do an illustration with wash loans for an IUL, it compares well with the returns of a whole life policy. Wash loans are not available on whole life products. We'll talk about that in a second. But then I said, well, if it compares well with the returns of whole life policy, then there's absolutely no reason to buy the IUL. He said, well, then that means IUL or whole life is terrible. It doesn't speak well for it. Blah, 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 blah. Again, it's the difference between Fantasyland and reality here. What looks good on paper and what actually happens in the real world. So I just thought that was funny. You don't have wash loans with whole life, but whole life is guaranteed to grow every single year. You set it up right, fund it properly, and you let it mature and get efficient enough, then the participating loans, because it's a non-direct recognition loan, and so when you use a whole life policy for tax-free retirement income, that interest on that loan, since you're not making payments because it's back to the loan because it's income that you're taking, that interest will compound against you. But by then, the policy is so efficient, it's growing so much every single year, it's not really an issue. I've run illustrations on this. Maybe I'll link them down below. I'll probably do an entire training on tax-free retirement income with whole life. If you want to check that out, I'll drop it down below and put it on the channel at some point. Make sure you subscribe to get access to it, whatever, notified. But the real thing that's wash loans. Okay. Wash loans don't solve the problem. right? So you can see the pattern there with IUL agents when I bring that up. But here's one of the most ridiculous things that I think I've ever really seen when especially comparing IUL illustrations to whole life illustrations, which you can't do because they're the completely opposite types of products. It's a really stupid argument. All right. Also, so you meant, I'm assuming you meant projections. In the illustrations of IULs, just like the illustrations in whole life policies, are averages. And some years are better than the average to maintain the average to make up for off years. Wrong, wrong, wrong. And I said it right here. A whole life illustration is not showing an average, guys. Are you kidding me? Like that is so stupid. A whole life illustration is showing it's utilizing the current dividend rate of the company. Okay, so when you look at the non-guaranteed column of a whole life policy, it's not guaranteed because dividends are not guaranteed, even though these companies have never missed a dividend payment. So I'm very confident they will continue to do so. All right, but they're not using averages. IULs use averages, if that's what you want to call it. All right, because it's based on stock market performance. The whole life illustration, nothing about it is based on the stock market whatsoever. It is based on the current dividend rate, assuming that the dividend rate doesn't change, which obviously it will. That's why I typically, right now, dividend rates are really low. So I think illustration, like actual performance will, like it's going to outperform illustrations right now because dividend rates have been have been so low for so long. They haven't caught up to the recently increased interest rates. So I think if you're setting up policies now, it's like a really good time to set them up because it's likely going to outperform in the long run. But you can control what dividend ratio or dividend rate that you are illustrating at. So if dividend rates get too high and you want to illustrate more conservatively, you can do that. But it's based on the dividend rate, guys. It's not based on any type of average. So when you see crap like that, just it's just that's what it is. It's crap. I don't know where he got that from, why he thinks a whole life illustration is using averages. It's using the current dividend rate and assuming that it stays the same. Like that's just stupid. So I think I'll wrap up there. I just wanted to go through some fun stuff that I have been experiencing with IUL agents recently. I hope that was helpful, guys. I hope it brought a little bit of clarity to different aspects of IUL, whole life, etc. If you'd like to have a conversation about this and just to help you determine which one is best for you, if either of them are good for you, then I'll have a link down below. You can book a coaching call. Let's have a conversation. See if infinite banking is a good fit for you. Whole life insurance. Well, we could talk about IUL if you want. I would never ever recommend or sell an IUL. I would never buy one, so that's a big part of it. But anyways, if you have any questions, drop some comments down below, and I'd love to hear your feedback as well. What do you think about this? I think it's always a good time in the comments. So either way, hope you guys are crushing it, and I will talk to you in the next one. To your success. Matty Ice is out.